What assets don't count against financial aid? Imagine trying to figure out how much help you might get for college costs. Knowing which assets are counted and which are not can make a big difference. Let's explore what assets are excluded from financial aid calculations and how this can help your planning. First, retirement accounts like 401ks, Roth individual retirement accounts, and traditional IRAs are not counted as assets on the free application for federal student aid. This means the current value of these accounts does not reduce your aid eligibility. But if you withdraw money from a Roth IRA to pay for college, that amount counts as untaxed income on the FAFSA, which can lower your aid. Keeping funds in retirement accounts can protect these assets from affecting your aid eligibility. Next, the equity in your primary home is generally not counted on the FAFSA. The market value of your house minus any mortgage or liens is excluded. So, families with significant home equity do not see that value reduce their aid chances. However, some private colleges use the CSS profile, which might consider home equity, often capped at a multiple of income. If you own other properties or real estate investments, it's important to know which form of aid application they will impact. Certain debts like credit card balances and car loans are not included in the financial aid formula. Paying off these debts can free up cash and potentially improve your aid prospects. Conversely, assets like cash and savings and checking accounts, stocks, bonds, mutual funds, and investment real estate outside your primary residence are counted. Second homes and vacation properties are also considered assets. For families managing private equity investments or business assets, these holdings are usually counted as part of your investment assets. Holding private equity in taxable accounts can increase your reportable assets. To reduce their impact, some families choose to hold such investments within retirement accounts or trusts that are not reported on the FAFSA. Timing also matters. Reporting income and capital gains in the correct tax year can influence aid calculations. For example, delaying income or realizing gains in a different year might help your overall aid picture. In summary, assets like retirement accounts and primary home equity are generally not counted against you for financial aid. But liquid investments, second homes, and certain business assets usually are. Smart planning around these assets, including how and when you report them, can help you make the most of your financial aid opportunities.